You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate veteran and value-add multifamily expert, Eddie Lauren. During his 30-year career, Eddie has been responsible for the acquisition of more than $3.7 billion in office, industrial, and apartment community assets nationwide. Since 2001, he has successfully purchased and transformed more than $3 billion worth of multifamily real estate, acting as either principal or advisor, amounting to more than 180 thriving communities with approximately 40,000 apartment units nationwide. Eddie also co-founded the HAPI Foundation, a 501c3 organization that brings education and sustainable health, nutrition, and fitness programs directly to the doorsteps of children and families living in multifamily apartment communities. Eddie's newest real estate venture, Impact Housing REIT, is on a mission to deliver good financial, social, and environmental returns to investors while providing more affordable, better quality housing, as well as HAPI-sponsored free health-related education, fitness, gardening, and nutrition programs to residents and families living in apartment communities. The fund is currently raising capital to purchase the first naturally occurring affordable housing apartment community in its portfolio, which is a high-rise community in Silver Springs, Maryland. And so, guys, I'm really excited to delve into Eddie's business to get a better understanding of both him as a person as well as his professional life as a highly successful real estate investor. But before we dive into it, I've got a few quick updates I want to run through with you guys. First one is I want to pay you guys a huge finder's fee for helping us uncover new mobile home park opportunities. And for those of you that don't know, that is our specialty. We buy manufactured housing communities, mobile home parks. There's many different names for it, but they're all kind of the same thing. We buy mobile home communities nationwide, and we're open for business. We're seeking new opportunities to add to our portfolio. And so if you're out there on the hunt looking for deals, whether it be multifamily deals, other types of commercial real estate, whatever it is you're seeking, if you run across an opportunity that's a mobile home community that's at least 50 spaces in size or larger, preferably larger, but we will consider down to 50 spaces in size, I'd love to chat with you about it. We're also open to joint venture arrangements. If you find a great opportunity, but maybe you want to try to take it down on your own, but you can't, you don't have the capital, you don't have the track record, maybe you don't have both. We're open to those discussions as well. So you can email me directly, kevin@kevinbuck.com, if you have a deal that you'd like to discuss. We can handle deals upwards of $25, $30 million. So it doesn't have to just be one deal, it can be portfolios as well. We actively have a couple deals in contract that we're working on that were actually brought to us by listeners just like you that wound up paying close to $200,000 in referral fees on. So if you'd like to put a big fat check like that in your pocket, definitely think of me and shoot me an email when you run across a potential opportunity. Next up, guys, I want to provide an update regarding our mobile home park fund. If you are a regular listener, then you'll know that we just recently closed out our first successful Reg D 506C offering, and couldn't be happier with both the parks that we purchased as well as the many investors that we had the pleasure of partnering with. Unfortunately, there were a few of you that didn't get in time, and we had to close it down. We had to turn you away, which we don't like doing. But I've got good news, and that's that we've got Fund Number 2, Mobile Home Park Fund Number 2, that we're working on rolling out here in Q2 of this year, so in the coming months. Okay, so if you've missed out on that very first fund, you have an interest in partnering with us on that second Mobile Home Park Fund, be sure to go to our website, sunrisecapitalinvestors.com. You create a free account inside our investment portal. This will basically place you on a first and no basis for when Fund Number 2 rolls out. In addition to that, you can also schedule a call with us where we can jump on the phone and actually give you a little bit more of a background about who we are and what we're doing and what that Fund Number 2 is going to look like. Okay, so we'd love to work with you. We'd love to partner with you. So again, be sure to go to our website, sunrisecapitalinvestors.com, and fill out that that free form. Get yourself into our system. Okay. Lastly, guys, if you happen to be in the Tampa Bay area, which is where I'm based out of, love to meet you if you're in town. Okay, if you got some extra time while you're visiting, just let me know when you're coming. Again, shoot me an email, kevin@kevinbuck.com, and we will work on coordinating our schedule so that we can hook up while you're here visiting. Guys, now it's the part of the show that you really are looking forward to. And so I'd like to welcome to the show today our guest, Eddie Lauren. Eddie, how you doing today?
Great.
Well,
thank you.
Yeah. Thanks for joining us, Eddie. Looking forward to learning more about you and your business and everything you've got going on. So you've been in this business quite some time. You've done $3.7 billion worth of transactions over the past 30 or so years that you've been in real estate as an investor during your 30-year tenure as a real estate investor. And so what I'd like to do, Eddie, I gave you a quick introduction. I'm sure it doesn't even scratch the surface of your background. So maybe take a few more minutes, expand on your background a little bit, tell our listeners a little bit more about yourself and also how you got into this business.
Well, great. Yeah, I'd say my claim to fame, besides being old now, is I love value add. I love to create communities out of neglected properties. That's really what excites me and always has. The opportunity to take tired old real estate, especially apartment communities that have really been neglected, and create thriving communities is one of the most exciting things. And I've come up with almost a franchise. I mean, we start with the sign. We want someone to drive by our property and say, oh, I only wish I could afford to live there based on the sign. Beautiful paint job, resort-style pool, state-of-the-art fitness centers, beautiful clubhouse, social areas, outdoor fitness, dog parks, places for people to thrive, outdoor community gardens. And then when we get into the interiors, we give people a clean, safe, affordable place to live. Treat them with respect and dignity. They stay, they pay, and they refer their friends. It's a very simple formula, somewhat boring, but it works. And everybody deserves a clean, decent home. And that's what we have made it our mission to deliver.
Okay. I love it. We're value-add investors ourselves, and I find huge rewards in taking something that's kind of worn and tired out, something that's been neglected over the years, and turning it into a place that the residents are proud of. So I'm on the same page with you there. What I'd like to know, Eddie, and I'm sure what our listeners would like to know as well, is how you got started. I mean, how'd you find your way into the, I guess the multifamily side, or just the real estate world in general? How'd you get to where you are today?
Well, I grew up of very modest means, but I did have an uncle who had some dough. He owned one building, he had a heart attack, and he never worked again at 50 and lived on that income. And I said, that's a good business. Whether he gets out of bed or not, he's making money. Mm-hmm. So to me, the passive cash flow concept was great. And that's what motivated me. So I started in all the food groups. I did office, industrial, retail. And then I finally honed in on what I think I'm best at, and that's bringing vision to tired apartment communities and transforming and making them into the thriving opportunities for people to dwell. So that was the natural progression. I did try a lot of different food groups, like I said, and honed in on really a multifamily. I think it's a lot easier than the others because, tenant improvements, leasing commissions, it's really an institutional market. Yeah. And you could take 5 years to get your cash flow back after you pay the leasing commissions and tenant improvements on those office buildings. Mm-hmm. So focused in on apartments, 1-year leases, you can be nimble, markets change. And I've, for better or worse, never had the institutional beautiful capital to buy shiny new. I've always had to buy deep value add and create and bring my vision to transform them. Mm-hmm. So that's how I kind of developed my niche and developed my skill. And wish I had that. It'd be easy to buy a product, pay a fortune per door, you get low returns, and you don't think about it. High fees.
Yeah, that's
never been my blessing.
Right? No, I mean mine either. So, no, it sounds like we're out there. We're grinding a little bit harder than those folks that have that type of capital. But it's fun as long as you enjoy what you're doing. Then it's not work, right? That's what they say. Right. So, I'm sure you remember your very first multifamily property. I like to create like a foundation. So, you mentioned that you started with all the other food groups and you worked your way into multifamily. And so in multifamily is really where your focus has been for quite some time. That's where you're at today as well. And everyone builds their foundation on that very first deal. I remember the first mobile home park we purchased, right? And I could tell you very intimately the details of it, and the challenges that were associated with it, how we overcame those, and how we changed our strategy moving forward. The second community that we purchased. So I'd like to learn just a little bit about that very first community, and what it was, where it was located, the size, and the opportunity that you saw when you looked at that.
404 units, I remember specifically. Mm-hmm. It was a big deal. It was very cheap. It was around $30,000 a unit in Jacksonville, Florida. And ended up taking that down with some institutional capital, but the kind that was looking for cash flow. And we ended up kind of breaking our pick and learning what to do and not to do on that asset. But it was really an amazing opportunity. It turned out all right. We sold it at $45 a door, and we were heroes. Wow. But in retrospect, it's worth a lot more today, as everything is.
Yeah, sure, right. Isn't that the old saying, like, you talk to some older investors that have been in the game a long time, they look back and start considering the assets that they've sold over the years, and they look at what they'd be worth today. It's like, I should have kept that. It's like, that's the beautiful thing about real estate is you don't even have to be all that smart. If you just hold on to something long enough, you're going to look like a genius in a matter of 15 or 20 years, even if you grossly overpaid for it in the beginning. That's
right.
Yeah.
But you need the right capital. And if that capital is hot money, which is what I've always had, they are 3 to 5 year money, and they need you to churn and burn, and that's how you make money. So I've never had the luxury of long-term family wealth capital. So
define hot money. Define how you mean bridge debt. Is that typically what, or some type of bank
equity equity that's IRR driven and cash flow driven. There's a preferred return you have to meet, and then after that preferred return, then you have a waterfall, and you're able to make money. But IRR killers are time. So the longer you hold something, the more the preferred return burns away at you.
Yeah.
And that's the challenge, finding the right capital.
So what has been your long-term strategy over the years? I mean, are you typically get in 3 to 5 years and exit out of that asset? Or, I mean, at that point, have you put longer-term debt in place and, got your investors paid back and, right off into the sunset, sharing distributions from that point forward after you've knocked off that preferred? I mean, is that part of your strategy as well, or do you typically like to get out of the deal and move on to the next?
Well, again, it depends on what your capital is looking for. Mm-hmm. The answer is both, all of the above.
Got it.
Every deal's different. Every deal's like a child. It has its own DNA and its own characteristics, and it's unique.
Sure. So what markets are you guys looking in today? I mean, what is your core focus? I know you're based on the West Coast. I'd mentioned that the first deal that you're looking at for this impact housing fund is in Silver Springs, Maryland, which is the complete opposite side of the country. Are you an opportunistic investor where you'll look essentially wherever the opportunity lies? It doesn't necessarily matter what state it's in? Okay.
That's right. Okay. I was looking for the right deal for this. This new impact housing fund is a non-accredited allowed investment vehicle, which is so extraordinary that people, regardless of income level or wealth, can invest as low as $1,000. It used to be, and I think that's how you do your investments, all your investors are accredited. They have to have a certain net worth and a certain income level. So this is what's so amazing about the Jobs Act that was passed in the last administration in 2012. Mm-hmm. So I came up with the brand, and I've been doing impact investing a long time. So let's talk about what impact investing is.
Sure.
Impact investing is defined as investing with a purpose. It's not just financial. So I look to get a triple bottom line out of these assets. First one's financial, of course, strong financial returns, cash flow, as well as your end result and reversion analysis where you get a really solid return. Our past track record, we've been in the mid-20s. Over the last few deals we've sold, about 40. And so, while future results are not necessarily guaranteed, and past performance doesn't guarantee future results, I'm talking SEC language. It's like a drug commercial, right?
Yeah, sure.
But the bottom line is that we have no reason to believe we're not going to get the same returns we have consistently delivered in the past. So anyway, the first bottom line is financial. The second bottom line is environmental. We look to save water, save electricity, come in and do certain things that not only save expenses and help the bottom line, but truly save our carbon footprint and make a difference in the world. So new plumbing, new fixtures, new toilets, new lighting, new security that's LED, all these things combine and make it so that it's really a unique opportunity. So what's this third bottom line? It's social bottom line. We don't rent to anybody who makes more than 80% of AMI. What's AMI? Area Median Income. That is the county's annual salary that the average person makes. So the definition of affordable housing in this country has been anywhere between 30 to 80% of area median income. Now, most of the 30 and 50 and 60% of area median income properties are all government subsidized and or with tax credits. So it's really hard to make those work and for the very low income or the working poor. It's kind of hard to do that in this market today. So what we focus on is just the standard affordable housing for the workforce. And that is a way to provide people with that clean, safe, affordable place to live. And that is based on their area median income. So not only do we rent to people and make it affordable, we also do social programming, health and wellness programming, as you mentioned, so people get real value. Because if you have happy residents, they stay and pay and refer their friends. And oh, by the way, the average turnover in America is 60-65%. If we can get that down to 50 or 45%, the amount of money we save on unit turns is tremendous.
Sure.
And that also goes to the first bottom line, the financial bottom line. So triple bottom line, financial, environmental, and social. And that when people get value, not only residents, but the investors, everybody wins.
No, I love that. And so I want to learn more about the social aspect of it, and more so about the HAPI Foundation, which is the acronym is HAPI. Tell us about the HAPI Foundation and how that gives back in the social manner.
Well, we developed a concept where when we own a property, there's nothing better than serving the residents where they live. We have beautiful clubhouses and great outdoor social areas. A lot of programming and self-help, stuff like that. That happens at a church, a YMCA, synagogue, whatever. That's all fine, but it's a lot harder to get people out of their homes and to get them to go and show up to these outside areas. But if we have programming on site, it really makes a huge difference. And people tend to show up. So we have after-school programming, we have community gardens and teach the kids. Some kids, you can't believe, in these lower-income communities have never seen a vegetable. They never realized that they could grow and eat what they've grown. They're sometimes in food deserts where there's not healthy vegetables or anything within miles. So it just depends on the opportunity and the property. And so we really provide value not only in terms of a clean, safe home, but a sense of community, teach them about health and wellness. We also are able to bring in Walgreens and they do health screening. We can bring in some government-funded after-school lunch programs for the kids. And of course, the way you drag anybody in is food, right? I'm Jewish, so everything we do is surrounded by food.
Yeah, no, absolutely. Okay, so I want to talk about this, two things more so, and I guess we'll tackle the A-plus offering first. If you would, take a few minutes and educate our listeners a little bit more about what that A-plus offering is. The more commonly known offerings have been Reg D 506Cs and Bs, with the 506C being only accredited investors, and the 506B, you cannot generally solicit with that one, whereas you can with the 506C. But the 506B, it's accredited, but also allows, I believe it's 25 or 35. You might correct me. I don't know which one. It's 25 or 35 non-accredited investors, but you cannot generally solicit, whereas
have a relationship for a prior.
Need of a pre-existing relationship.
Yeah.
And so the A-plus offering allows both accredited and non-accredited. And in addition to that, well, I'll let you tell us a little bit more about it. I'm not going to butcher it. So why don't you tell us about the A-plus offering and the beauty of that new tool?
Well, it used to be that the average investor had to go to Wall Street and couldn't invest in opportunities that they wanted to invest in because, needed a securities license to do so. Now, and with the advent of this Jobs Act, non-accredited investors can come into these types of offerings for the first time ever without Wall Street. And that cuts out the middleman, of course, so there's a better value there. And a lot of the opportunities that we would do, and it sounds like you would do, Kevin, wouldn't be purchased by the Wall Street REITs. So this gives people an opportunity to come direct to people like us. And that's what's tremendous. It's a tremendous opportunity. So Reg A Plus allows anyone and everyone, regardless of how much they make, so they can come in directly. And that is revolutionary, and that levels the playing field. It democratizes the society of investing. And, the millennials tend to want to invest with a purpose. We talked about impact investing. There's about $14 trillion of wealth that's going to transfer from the baby boomers to their children who are millennials. And they're more comfortable investing online directly. And that's going to be a big sea change and a big shift in the way things are done. The white-haired guys that are managing money are not in favor for the newer generation. So this was a huge win for everyone who wants to be able to access investors directly, and for investors who want to access people like us directly.
Okay, fantastic. I mean, how does that really? How do you guys differ? The impact housing REIT that you formed, how does it differ from the other opportunities that are out there in the marketplace? I know the
other Reg A Plus.
Yeah, I mean, well, just the other offerings offered by the big operators. I mean, you got the Blackstones of the world, Turner, and what are the differences? You mentioned like the asset itself. I mean, they wouldn't typically be going after the types of assets you're going after. What are some of the other differences that one might see by getting involved in your A Plus offering versus a Wall Street?
Well, you mentioned one name, Turner. Mm-hmm. I actually renovated 2 high rises, and he bought from us. So who's the impact investor there?
Sure, yeah. So they're looking to buy the stabilized assets, and you're going in and doing the heavy lifting and making the difference, and they're just they're looking for the finished product.
That's correct.
Fantastic. So I want to talk about this deal in Silver Springs, Maryland. This is one of the first that you've identified for the impact housing REIT. Talk to us more specifically about what you intend to do, like the opportunity you see in that particular property in Silver Springs, and what are some of the improvements that you intend to do, assuming that you do end up closing on that.
Well, I love this deal because I love high rises, as I just mentioned. We look at high rises like what would a hotel look like? An older product, there's Mondrian brands and Viceroys, if you know these typical brands. And what's cool is taking those ideas and implementing them into workforce housing projects, because people really get a kick out of having that vision and that feeling of being in a high-class place. We give A amenities to B and C residents, and they really love them. So the common areas are very important. We make them look like hotel lobbies, and the common areas on the upper floors, there are incandescent light bulbs, so we're going to come in with a really nice lighting package and beautiful carpet tile instead of linoleum, so it doesn't feel so institutional. Mm-hmm. So those carpet tiles are patterned, and if someone spills, you can just take up a tile, so that works practically, and they tend to look really nice, mm-hmm. which is cool. So that's one of the things we do. Another thing is creating a common area where we have outdoor fitness, a dog park, and social areas and barbecue areas, etc. Another option that we are implementing is some of that health and wellness programming, and the way for people to have running tracks so people can actually get active together. And the key to this particular deal is there's 48 townhomes that are individually owned by individual owners. One water bill. Is that funny? One water bill coming in to the entire property, 143 unit high rise as well as 48 townhomes. And the current ownership is guessing on how much to bill back. So the key here is we believe that we're going to substantially recoup more more rent, in terms of their water bill payment. And we're going to put in low flow toilets, and we're going to be able to fix some of the plumbing issues that they have had some leaking, and we found those leaks in some of the copper plumbing. So the overall value add is a lot of water savings and, of course, water expense savings. So financial bottom line, environmental bottom line. That's what's exciting.
Is there an opportunity in a high-rise structure like that to actually put individual water meters in per unit, or no? Is that not feasible?
Well, we do what's called a RUB system, resident utility billing system, and it's in essence the same. Sure.
So. Got it. Okay. So as far as the project management side of a renovation project to that magnitude of this high rise, I mean, you're talking one building, one structure. Let's separate out the 48 townhomes. I mean, will it be like a floor by floor type renovation? I mean, because you can't really shut.
Yeah, we'll spend $2 million in renovation, and we have our own crew, which we come in and we have certain contractors. We do stuff ourselves. Some are. And, sometimes there's, we do it in-house. It's a combination of things, but we go in, we project manage and transform the asset, and we don't really raise rents until we get to the point where we've earned the right to raise someone's rent, and they're happy to pay. We don't raise the rents a lot, but we do have to pay for our costs. We are in business, but, if you give people value, they'll pay.
Yep, I
That's
agree
the thing. So many people make a mistake. They go in, they say, "Hello, here's your new rent. We're your landlord. Here's an increase of $100." Like, what? Wait a minute. Who are you? What are you doing? But over time, we start and we take about 6 to 9 months on the exteriors. We renovate the exteriors. Then they see that there's something happening. Oftentimes, like this property has no pest control contract in place right now.
Wow.
So that's an example of how some of the things that we can take low-hanging fruit and make them feel happy.
I'm assuming that's not required by law then in the state of Maryland for a multifamily structure then, the pest control, whereas I know in Florida it is. Is that the case?
I mean, it's just a lack of
I got you.
focus.
Just a lazy management team.
Just an example.
Yeah.
It's not like it's infested. I mean,
how about the management of these properties, these assets? I mean, do you guys have your own internal property management company? Do you outsource it to a third-party firm?
We outsource to third parties. We feel that it's very important. We're good at renovating, buying, transforming assets. We're not necessarily, because we're nimble in different markets, we're not the best at being in the employee business, right?
Sure.
That's the key to management. It's employees and incentives, and we leave it to the professionals to do that. And we asset manage. We ride herd over them and make sure they implement our business plan, our vision, etc.
Do you have a few national firms that you kind of rely on in the different markets that you're in? So you're not necessarily going into a new market and seeking out a firm, in that local marketplace. You're looking for a national player that can, essentially handle wherever you're buying assets at that given time.
Yeah, but every market's different. That's why you want local expertise, and you want to interview different players to make sure that we all keep each other honest, right?
Yep, absolutely. So now I want to ask you a question, Eddie, that I might catch you off guard a little bit. I throw this one in every once in a while. So I feel like we, being entrepreneurs, being businessmen, we always learn from our mistakes. And if you're not making mistakes, then you're not really growing. And some of these mistakes typically aren't, they might not be our fault, right? But they might be a mistake that was made or that we fell into, and we learn from them, we move on, and we grow. And so if you would, if there's maybe a story, a short story that you might be willing to share, or a time when either you experienced there was a mistake in your business where you might have experienced a loss or some kind of downturn of some sort. It could be even a lawsuit or a bad partnership, something along those lines that was a negative period. You don't have to go into too much detail about, but really my goal here is just get an idea what that period was, and then what you took away from it. What was the learning experience that you took away from it?
Well, the number one rule when you hear from auditors and accounting classes in college, I should have listened to. I had a great relationship with a partner, an equity partner, who turned out to be predatory, and we were overexposed to them. So don't get too overexposed to anyone. That was the mistake. And it's like the banker. You borrow $100, the bank owns you. You borrow $100 million, you own the bank. Mm-hmm. That kind of thing.
Got it.
So, okay. I mean, it's concentration. You need to diversify your investors, diversify your management, diversify everything so that you can't be held hostage by anybody.
Mm-hmm. I want to go back a little bit. I want to talk a little bit more about your impact housing REIT. And I want to get a better idea of where you're at. I know you got this first asset kind of teed up, but give us a better picture of what this looks like. How long is it open? I mean, how long is the opportunity open as far as investors are concerned of putting money in and becoming part of it? And I don't know how much you can truly share, but I'll let you kind of run with that and just give us some more details for those that might have an interest.
Well, I think it's a great opportunity to get access to someone like me that never existed before. If you're accredited investors, of course, always could if they knew me. But the non-accredited world, you can really make a difference in society and make money at the same time. And I think that's what the sea change and this shift is happening in this society because of the current administration. Honestly, there's not a huge commitment from the top lately to support and solve the housing crisis with tax rates that have been reduced from 37% to 21%. Mm-hmm. That makes less incentive for tax savings, and that money is not going to be there to help the working poor. So a lot of opportunities out there are focused on shiny properties. They're focused on, safe investments, so to speak. I use that as tongue-in-cheek. My argument is affordable and workforce housing is more safe than anything, and that's what we do. So I think it's a great opportunity for people to get into safe, affordable housing for a little bit of money and give it a shot. The real essence of this business is basis and stability. And if we're going to be, we all think that the real estate market may be toppy. Would you rather invest in $1,100 rents, or would you rather invest in $5,000 rents today at this point in the cycle?
Yep.
What we're doing is giving people an opportunity to invest in basic housing that gives people a clean and safe place to live. And I would argue that's way safer than a lot of the brochure stuff that people are investing in today.
I agree with you. Is this a blind pool? I mean, will there be more than one opportunity in there?
Yes, there will be.
Okay. And what's your target capital raise, and how long will that raise take place? I mean, is it a 12-month, 24-month period?
It's a 24-month period, and we our max raise is $35 million, and we'll take what we can get. This is a new concept.
Okay.
That's in the $1,000 investments, you need a lot of them to grow. So we're going to take it as we go, and we're very excited about the opportunity for everyone to get in and to take advantage now. Since.
And you typically use leverage, I'm assuming.
Yes, we do.
Okay.
We do. And we do, I sometimes do joint ventures with other good partners that I've grown to trust and love. And so, there's all types of opportunities to get a diversified pool, but the bottom line is we focus on the resident. If the resident's happy, they stay, they pay, they refer their friends, and that's how you create thriving communities.
Absolutely, I love it. So Eddie, I want to back up a little bit. I want to ask you to kind of jump into your DeLorean time machine, Back to the Future reference there, and drive back in time to year one when you were just getting your feet wet, and obviously you got your start, not necessarily multifamily, but in the other, the different food groups of commercial real estate. And so, knowing what you know today, if you go back in time and give yourself some advice in year one, what would that advice be?
I would try to find the right capital that's aligned with your interests, and like I said, diversify that capital and make sure that you end up with a symbiotic relationship with capital partners that I'll call appreciative capital. They appreciate what you do, and you can tell if someone's trying to second guess you and look at what you're doing and criticize and think they know better. Well, the fact is, if they know better, they should do it themselves. So keep in mind that, some investors are not necessarily in it for what you're in for. Try to keep that aligned, and the way to best support that is to diversify your investor base and try to make as many relationships as you can, and find that capital that's completely aligned with your interests and your goals.
I love that. I absolutely love that. Okay. Well, sounds good, Eddie. Well, you've shared a lot of golden nuggets with us throughout the call today, and now I'm going to enter what I like to call the golden nugget segment. So we're going to wrap things up for the day. And if you just had one last final golden nugget of advice or wisdom that you could leave with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
Never give up.
I love it. I love it.
It's very hard. It's a hard business.
Yeah. I mean, mine's quite simple as well. Take action, right? You can add to it if you want. Get off your butt, take action, do something, make forward progress, make forward movement. Fantastic.
And it's the powers in the universe, you have to believe in them. You have to believe that you're doing the right thing, and deals will align, and you will align with the capital and all these things. It's a risky business, and it's not for the faint of heart. But you have to believe strongly in your values and what you're doing, and that you're making a difference in people's lives, and you got to hope that transcends everything else that's out there, because it's really competitive.
Yeah. No, I love that. Well, Eddie, this has been a lot of fun. And for those that want to learn more about Eddie and his company and this impact housing offering that he has, that they just recently launched, he can go to impacthousing.com. Again, that's impacthousing.com. And Eddie, that's all we have for today, my friend. I really appreciate you coming on the show, and I wish you the best with this most recent offering. And I'll look forward to hopefully maybe having you back on the show at a future date and checking in with you, getting a status update. Maybe we'll get you back on a year from now and check in and see how things are going, and take a look at some of those opportunities that you've been able to take down and turn around. So that would
be fun.
Yeah, that would be fun. It'd be a little bit of a progress or report card, right? We'll give everyone an update of where things are at. So Eddie, been a blast. Thank you so much. You have a wonderful day, my friend.
Godspeed, everyone. Thank you.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.